With markets reaching all-time highs again, there's no question as to whether we're in a bull market. So I thought it would be important to share some characteristics regarding bull markets as you think about your own portfolio and investment strategy for the year. First, what is a bull market? A bull market is a period of time in upward trending market prices where prices have gone up by 20% or more from their lows. Notably, the only way to recognize that we are in a bull market is after it's already happened, but more on that later. So in general, optimism is very high, so investors feel confident, which pushes company earnings and stock prices upward. Although they are related and often correlated, it's important to recognize that the markets in the economy are two separate things. I often refer to the markets as the economy's temperamental sibling. But what's important to know is that markets are forward-looking, meaning they are anticipating something to happen and are adjusting their prices accordingly, whereas the economy is looking towards the past. This is measurements and data points about what's already happened in our economy. So markets look to leading indicators, whereas economic data is considered lagging indicators. And this is often why markets react to economic news, particularly if anticipatory market prices were wrong according to what's happened in the economy. For example, if economic growth just wasn't as strong as the markets thought they would be, we might see market volatility as the markets begin to correct. Both bull markets and bear markets are completely normal and common. In fact, the S&P 500 index has experienced about 27 of each since the 1920s. Check out this graphic from Hartford Funds. Each period of blue represents the bull markets and the gray represents the bears. When we look at this, obviously the growth is more substantial than the contractions, and that generally bull markets are longer and stronger than bears. But bear markets are still one of the biggest risks to a retiree and can easily destroy a retirement plan. That's why it's important to have your investment portfolio set up in a way that's fitting for your goals in both kinds of markets. This is especially true if you are retired or close to it. We can't control the market, so if you're invested in a way that only relates to bull markets, what happens if the market flips and now we are entering a new phase of bear markets? How will you be able to continue with your plans and financial goals if you didn't account for this in your plan? And it's important to know that the length in time between bear and bull is not always the same or consistent, but on average, bull markets have been much longer than bear markets. How can we know that we're in a bull market? Remember, it's only official after the markets have moved 20% or more higher off of their recent lows. Well, it could take weeks or even months for it to do that. And if we wait for the markets to rise enough until we're comfortable to invest in it once again, then we've actually missed a large part of the growth already. This is one of my favorite graphics, where the blue line represents stock prices or market prices as they go up, down, and then back up again. And each point along the way, we can begin to see the general investor sentiment as time goes on. We have optimism and exuberance as the markets are growing and becoming really high, very much like what people are feeling right now. But obviously, this is also potentially the point of maximum risk, because we don't know if the markets are going to go down from here. And we can often see that as markets begin to fall, people start to panic and capitulate, which is really when they should be gearing up to reinvest because markets have suppressed prices again. And take a look at these emotions along the way. If you've felt any of these over the last year or two or maybe 3 years, then let us know by hitting the like button on the video. Ever since the 1920s, the first half of a bull market has outperformed the second half almost 75% of the time. So think about this. While you are feeling out the markets and thinking about whether you want to reinvest, 75% of the time, the majority of the growth has already been provided, and anybody who was not invested missed out on it. In fact, it's commonly known that if you miss the 10 best days in the markets in any given year, you've actually missed out on more than 50% of the growth that's going to be available in that year. And that takes us to the next one. It's so easy to miss the boat. According to Morningstar, the first month of a bull market averages around 13.6% return in that first month. What about the first 3 months? New bull markets have an average of 25.3% return during those first 90 days. Folks, think about how hard it was for you to get back into the markets. If we look at last year as an example, it was not until April or May until TSP participants felt comfortable once again pouring back into the S funds, the C fund, and the I fund. So you can really start to get a sense for how traumatic it can be on your portfolio if you end up missing out on these huge returns, especially after having sustained losses like the years prior. One of the most challenging components of identifying a bull market is the fact that they look very different from each other. Remember that graphic that I showed you earlier about the past bull markets that we've had? Notice how some of them are much bigger than others. In fact, the longest bull lasted for more than 12 years from the late 80s to 2000, while the shortest only lasted 25 days in the 1930s. So if you try to time yourself back into the bull markets, what's to say you've not already missed the bulk of that regrowth? Overall, the S&P 500 index has historically returned about 114% during that bull market stretch. But ever since the 1970s, they have been getting longer and stronger. Does that mean that we can expect this trend to continue and that bull markets will keep getting stronger? You guys know the answer to that by now, but there is certainly evidence that markets are much more mature today than they were in the past. It's incredibly exciting to see your portfolio skyrocket through new highs as they have recently. But at the same time, it makes people who haven't been participating feel like they're missing out. Remember that investor emotion cycle? People often only start to have these feelings of FOMO after seeing how much growth the markets have been offering lately, when you could actually be getting closer to the point of maximum risk before we flip to the next cycle. But again, staying fearful might mean that you miss out on potentially months of more growth. So one of the best things that you can do to your portfolio is to remove the emotions out of your decisions. But as we all know, that's easier said than done. And this is where having a financial plan can be really valuable. If you can develop your strategy ahead of time, then you'll know how you need to be invested regardless of what's happening in the markets. The best way to make the most out of a bull market is just by being invested. The only way that you can participate in that growth is by holding the asset classes that are designed to outpace inflation. However, I highly suggest that you find a trusted financial professional to help you put together an investment strategy for your plan. Don't just listen to the concepts in these videos or any others that you might be watching. This is a really important part of understanding how to use that tool, which is the markets. And just like any other tool, if you misuse the tool or you use it in the wrong scenario or in the wrong way, then you might actually cause yourself more harm than you really intended. Investments can have a lot of intricacies, including even the simple TSP funds. Sometimes investors don't realize that they can behave a particular way. A lot of people were caught by surprise in 2022 when even a conservative investment like bonds were down double digits. So take some time to think through your plan this year. And if you're retired or coming up on it, consider subscribing to our channel. And until next time, stay wise and stay wealthy.